Bull versus bear market. What's the difference? You have probably become familiar with the terms bear market and bull market in the context of discussions regarding the current state of the stock market. What exactly differentiates the two of them from one another? Hello everyone and welcome to another video on our channel. In today's video, we're going to tell you the difference between the bull and bear market. Yeah, you heard it right. So let's start our video. Bear versus bull market. Tossing a coin has no control over whether it will land heads or tails. Hence, the outcome is completely random. If you flip a coin 100 times, you may see a pattern of heads and tails. You can now compare this to a short-term stock market action like a downtrend or an uptrend. Like the outcome of tossing a coin and seeing if it comes out heads or tails, it cannot correctly forecast the short-term movement of the stock market. The term bear market or bull market refers to a series of consecutive upward or downward price movements observed over the long term. Stock markets are considered to be in a bull market when they're rising or are likely to rise. A bull market is one in which stock prices rise steadily over time without falling by more than 20% from their prior 52-week high. Bear markets are also used to describe a market environment in which prices are likely to decline or have already fallen by at least 20% from their peak. Do you know why these periods are referred to as the bull phase and bear phase? The origins of these names can be traced to a variety of sources. A common explanation for this naming convention is the ferocity with which these two creatures engage in combat. A bear will use its claws to grip and drag its victims down as a bull pushes forward, throwing its horns high in the air. It is a metaphor for the current state of the market. If it rises, the market is said to be advancing, and if it falls, it will drag itself down. What causes a market to rise or fall? Many different economic reasons can cause a bull market phase or a bear market phase to develop. Throughout history, it has been seen that both phases take place one after the other in a pattern of an alternation. In a bull versus bear market, what is the best strategies? Buy low, sell high is the best investment philosophy. That means you should invest in a bear, resell in a bull market. Yet, investors tend to flock to equity markets during a bull run and can only make money from their investments during the next bull run. Investors who lose faith in the market book losses and depart the market. As long as you don't overlook the company's fundamentals, picking stocks based solely on their current price is a good idea. In a bear market, you need to know if you're getting a knife or mango when you invest. It suggests that investing in a stock in a bear market, one should always look at companies with good fundamentals rather than a stock that's more like a dropping knife. When to buy and sell stocks in a bear or bull market. Investors may be tempted to liquidate their holdings during a bear market to avoid more losses. On the other hand, a bull market allows investors to make money by selling some of their shares or holding on in the hopes that prices will continue to rise. It's easy to get caught up in the market fluctuations, but most financial experts advise against it in the long run. Refrain from frequently checking your portfolio to prevent reacting to market movements. A knee-jerk reaction occurs when an investment loses value, so avoid it by checking up on your investments as rarely as possible. Using a robot advisor is a cost-effective and convenient option to automate your investment strategy. Rebalancing is an automatic process in which a robot advisor, like Betterment or Wealthfront, makes adjustments to your investments regularly, known as rebalancing. Investors should know that a growing stock market indicates a robust economy, while a falling market indicates a possible bad economy. In a bull market, it's easier to have faith in your assets, but in a bear market, maintaining the course is usually the greatest move you can make with your money. Demand for and supply of financial instruments. Stocks are in high demand and low supply in a bull market. Or, to put it another way, many investors want to acquire securities, but there aren't many who want to sell them. Due to the intense competition for available stock, share prices will rise. More folks are looking to sell in a bear market than buy. Because the demand is much smaller than the supply, share prices fall. Psychology of the investor. Investor psychology and mood have a role in determining whether the market rises or falls, since its behavior is influenced and defined by how a person perceives and reacts to it. The performance of the stock market and the mindset of investors are intertwined. During a bull market, investors are eager to get in on the action to make money. When the stock market is in a bear market, investors begin to shift their capital out of equities and into bonds while they wait for the market to recover. The decrease in stock market prices has shaken investors' faith. As a result, investors keep their money out of the system, resulting in a drop in the overall price of the stock market. If you're considering investing, it's a good idea to wait and see how the market is performing before making a final decision. Keep in mind that the stock market has always had a good return over the long term. Well, that's all for today's video. Tell us in the comment section what you thought of this one. I really hope that you found this video interesting. If you want to see more just like this one, please consider subscribing. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.